Hello, everybody, and welcome back. Next, he is an entrepreneur with extensive banking and blockchain experience. Previously at BNY Mellon, he was the blockchain lead and founding head of the emerging business and technology team. At UBS, he was founding head of the blockchain-focused FinTech Innovation Lab in the UK's Level 39 Accelerator. He co-founded utility settlement coin, Enterprise Ethereum Alliance, and trusted IoT consortias, and was featured in the 2015 FinTech Finance 35 and 2016 FinTech 40 list. Please put your virtual hands together for our guest, Alex Batlin. Alex, welcome to the program.
Thank you so much, guys, and thank you for the introduction. So by that, it means for the last 4 years I've done nothing because I've not been part of any lists. That's quite depressing.
So tell us what you're working on now and get on those lists.
Yeah, absolutely. Thank you so much. I'm just going to quickly share, talk through that. But absolute pleasure to be given the chance to talk to you guys. I hope everyone's kind of doing well under the lockdown. My name is Alex Batlin. As mentioned, my key focus right now is running Trustology. Trustology is a custodial wallet provider. We mainly focus on institutional clients, but of course, we also serve individuals as well. So we do have both business and individual accounts, and we do also sell our technology to banks who can effectively install the technology platform we operate for ourselves and serve their clients. Today, really what I wanted to do was share a few of my thoughts around the future of banking, or reinventing banking with DeFi. And the reason I say that is because kind of before starting Trustology, I worked in banks all my life. I started off at JP Morgan, then went on to Nomura, then UBS, where I ran the innovation function, and then on to BNY Mellon, where I did roughly the same. So at that point, everyone talked about the future of banking, and the assumption was it was going to be a little bit like before, but a bit more digital. But I think big things are changing, and I think there might be more change than most people expected. So one of the really significant things that has kind of recently happened in the crypto ecosystem is that there's been a clear go-ahead from the US regulators that the US banks are there to offer crypto custody. And everyone's getting excited about it because it means it's going mainstream. And I think that's good news, because I think many of the benefits we talked about as decentralization, and I'll talk through a little bit more in a bit, are key. But what if the headline in a year's time looks a bit like this? US banks replaced by DeFi. Now, it's a slightly ambitious headline. I don't believe it will be like that. But will DeFi potentially take a large market share? It's possible. And obviously depends on where you are. So if you happen to be in a well-banked country like UK, that's probably less likely. But if you happen to be in a jurisdiction that's somewhat underserved by banking, then that might actually be a much more true statement. So I don't like doing anything unless I kind of understand why am I doing that. What's the hypothesis? What do we think we're going to gain by doing something? So I just wanted to talk quickly through why do I think DeFi is important? How is it going to benefit people all around the world? And really kind of most people, when they think about finance, it's about wealth creation. You are trying to create wealth. So that's the main thing. How do we create wealth? Well, typically, if it's kind of companies, you take some inputs, which is capital, labor, and so on, and you convert them into outputs, and which are services for your clients. And hopefully, the output is higher than the input. You created wealth, and everyone shares in that wealth creation. But to bootstrap that process, you need to have some initial investment of money. Some people invest their time, others invest capital. Sometimes you want to back that up with loans because you don't necessarily want to give up equity and you can get a loan. And then even more simple stuff, kind of payments. You need to be able to receive money and send money. And then, of course, things go bad. If you have too much risk, business may not be viable, but you can now get insurance to reduce the risk and therefore make a business viable. And similar, alongside insurance to some extent, is hedging. Let's say you are a raw goods business and you heavily depend on the price of raw goods that can fluctuate. You can hedge, which is another form of insurance against volatility of pricing. So all these tools are there to help with wealth creation. But the problem is, in many jurisdictions, they're not either available or affordable. And usually those two things go hand in hand. It can be unavailable because it's just the situation in the country is such that the profit margins that a central service provider needs to have are too low, and therefore they don't go into the market at all. Or even if that service is available, it's available to such a small number of companies that for all intents and purposes, no one at the lower end of the income scale can actually get access to that and afford it. So either way, all of those things are barriers, because if you can't take electronic payments and you can only do cash payments, you're limiting yourself to your physical market, 30 miles. That's all you can walk on a realistic basis. So that means you've got a tiny market. So the probability of you being able to earn a lot of money is quite low. As soon as you can do electronic payments, you all of a sudden expand yourself to the global market, potentially. But of course, a lot of the time, people on lower kind of incomes simply don't have access to electronic payments because it's too expensive by the banks to provide them that service, given the lack of KYC information and the interest they can earn. So that service is simply unavailable for them. So there are many, many barriers about availability and affordability to enable payments, to enable insurance, to enable hedging, loans, and investments in certain jurisdictions. But without those, you can't create wealth. So in that case, if that's true, then we need to think through a little bit about how can we break those barriers down, availability and affordability, in order to enable wealth creation for a larger number of people that are undeserved today. One of the kind of interesting things about centralized finance is that it actually, in many cases, works really well, especially if you're in a kind of affluent country. It's relatively efficient, so you're only doing things once. But the problem there is it has, because you essentially have to rely on a single service provider, once you've started using this, quite typically you have very high switching costs. Because kind of you start to kind of build everything on top of that. With high switching costs, it means that the service provider can actually charge a lot of money for that, because they do value-based pricing. They understand that they can charge you more simply because for you to move is too expensive. So they will up the price to the highest point possible until you move to somebody else. It's normal business. They're not bad guys. Their shareholders will be sitting there and going, are you maximizing your revenues based on value-based pricing? It's not a bad thing. It's just how business works, unfortunately. At which point, of course, it means that kind of many countries where the kind of earnings are not enough simply do not meet the return on investment threshold for people to offer the services in particular jurisdictions. And a lot of people equate that with bad people. They're not. They just look in the numbers and they're saying, if we put $10 into an enterprise in Europe, we get 20% return. If we put it in some other jurisdiction, we get 5%. and they simply cannot justify to their shareholders putting it into markets where the ROI is not big enough. But that, of course, reduces the availability of those services, which then has a knock-on effect that we're not creating the wealth creation capabilities, which is bad news for everybody else. Decentralized finance, though, flips it on the head because and I mentioned this competition on the left-hand side. And that's a really interesting point there because we often think about competition as, well, if I don't like, service provider Stripe, I'll move to PayPal. But we already said that the high switching costs are just that, high. So you're not likely to move unless there's a considerable price drop. But with decentralized finance, you can actually have internal competition because you can keep your APIs using the blockchain. But if some of the miners are becoming too expensive, people can come in and do validation transactions cheaper to drive the price of validation lower. So it's a really interesting phenomenon. It's a new type of competition. You're competing within the same ecosystem to provide the cheapest service. So there's no switching costs for the provider, but you can drive the price down for the validation services, which with increased competition, hopefully you'll get down to much lower prices in the long term. So simply it's cheaper. And if it's cheaper, you can make it available to a larger number of people. And if it's available to a large number of people, we now can have a much bigger impact on wealth creation. Then, frankly, decentralized finance is all about automation. Now, you don't need to have decentralization to help with automation to reduce cost, but of course, it does help. And DeFi promotes automation front to back, so it drives the cost down. So it's a driver, but it's not a primary driver. The other really important thing is this combination of reconciliation and resiliency. Because everyone is worried about over-relying on a central service, because essentially you now have a single point of failure. What do? We effectively encourage competition by providing alternative services and also by splitting up the stack of service provision. So, in the real world, outside of crypto, exchanges cannot be custodians. Why? Because the regulators effectively want the custodian to act as a policeman and so on. So they're trying to segregate those kind of entities and also promote competition. But like we talked about, as soon as you have competition, you have high switching costs driving the price up. Blockchain, and all of this is because essentially people don't trust the centralized service enough, so they're trying to reduce the risk by segregating the duties and encouraging competition. Blockchain, on the other hand, has a really interesting aspect to it because it's logically actually it's centralized. Because think about Ethereum. Everything happens on this Ethereum rail. You can effectively, in a single block, do clearing, settlement, transfers, everything. So logically, in a weird way, it's centralized. But operationally, it's decentralized because no single entity is controlling that, which is extremely resilient. So because we now have this idea of logic centralization, we don't need to do the same level of reconciliation. And reconciliation between services is very expensive. Whilst we have sufficient resiliency so people can trust this centralized logically, but decentralized operationally service. So just to give you an example, let's take a look at a typical trading DeFi ecosystem. You got exchanges, clearing houses, central security depositories, custodians, agency banks, share registrars, issuers, central banks, broker-dealers, and investors. And there's actually a lot more than that as well. This is a simplified version. So first of all, there is regulator-mandated segregation of duty between exchanges, CCPs, and CSDs and custodians. Each one of those now has to reconcile, and that's expensive. What's your database? What's my database saying? Constant reconciliation and time delays, because they typically reconcile in batch once a day. So you're slowing down the trading cycles and increasing the cost. And then similar, of course, we also have the competition. So multiple different exchanges. If you happen to be a share registrar, now you have to register and reconcile between exchanges in the same country, And it gets even more expensive when you do it globally because you have to do it per major set of exchanges in each country. So the cost keeps increasing and increasing. In a DeFi system, you can, in a safe way, because it's decentralized operationally, in principle, bundle it together into the same plane and no longer have to reconcile between all those different competitors and between the different kind of service providers that have been segregated along the value chain. So we can reduce costs. That's what it comes down to without sacrificing resiliency. In fact, I think improving resiliency. So what does that translate to longer term? Well, we started off with the the asset issuance layer. The Bitcoin came out first, then Ether, then ERC20 tokens, and so on. And you need that because you need the underlying asset issuance. Sometimes they're synthetic assets, meaning that they're title deeds representing physical or other assets, and some of them are natural ones. So Bitcoin is native to, for instance, Bitcoin. There is no other record of it. Security tokens could be representations of securities on a central database represented as tokens on blockchain. But now we're starting to move up the chain, decentralized exchanges and lending, NFTs, stablecoins, digital assets, and then so on. So what we're doing is we're creating the entire ecosystem. Now, right now, we're actually in this perilous time because a lot of the asset issuance is decentralized, but all the other services are centralized. So actually kind of get the worst of both worlds. We have the cost of decentralization because it costs more. You have many replicants doing consensus. It's technically cheaper to do it once centrally, but we don't have the resiliency of decentralization. So we're in this transition phase right now, where in some ways we're in the worst of both worlds, and we need to keep moving towards decentralization to the largest possible extent so that we drive the best value of DeFi, which is the resiliency, the cost reductions without the centralization's risks. So we need to make sure we keep pushing this agenda on and on to really get the benefits, because if we stop right now, we're actually in the worst place than centralized finance, in my opinion. But then, of course, to make this whole thing work, you need the on-ramps, the wallets, and the portfolio managers. But once we build all of this together, we actually now have genuinely a new banking ecosystem. And really, the future bank is a decoupled set of services that you access through probably something like a wallet. So I'm starting to think about wallets nowadays as the equivalent of the web browsers. Think of it as the finance browser. It allows you easy access to all the different services that typically the banks would have done, but banks would have bundled this and charged rent-seeking fees on top of that. By providing a wallet that connects to multiple DeFi protocols, we get to the position where effectively we have the best of both worlds, extremely resilient systems that are easy to use and much cheaper. And just to give you an example of just the breadth and the width of the incredible work that is being done by DeFi projects all around the world, covering pretty much the entire life cycle of financial services that you need to care, from payments to lending, identity management, tokenization, trading venues, etc. So super exciting space. I hope you pay attention to it, and hope I've inspired you a little bit to think about it. And if you want to find out more, or you're looking for a custodian that supports custody, for instance, because a lot of the time what we find is that institutional clients do want a custodial solution in order to feel confident to use DeFi. We're one of the very few, if not the only one really, to support, for instance, MetaMask. So you can start actually using DeFi in a really, really safe way with us straight away. So thank you for listening. Hopefully that gives you a little bit of an insight, and do reach out to us. Contact at Trustology trustology.io, or check out our website, trustology.io, to find out more. I'm just checking for kind of Q&A. I think there is one question. With banking, there are authorities checking that banks follow the rules and don't do anything bad. How can we trust the smart contracts on DeFi? Who audits, checks them, make sure they have no bad code, etc.? Great question. The short answer, right now, no one. So right now we are relying on the wisdom of crowds, because effectively, if you think about the current centralized finance, there is no way you can look at the code. It's proprietary. As a customer of Bank of New York Mellon's, where I used to work systems, you would call them up and say, "Can I have a look at your code?" And they're like, "No, you can't." The only way that they could be forced to do so was the regulators come in checking what they do. In principle, with DeFi, anyone can read the smart contract code. So you can start to kind of natively, it's open, so a lot more people can investigate it without the authority of the regulator. So that's one advantage of DeFi over CeFi. But just because you can read the code, it doesn't mean that vast majority of people can read the code. And therefore, we need to make sure that essentially, I think there will be some form of regulatory oversight on DeFi contracts, from formal proofs to check for bugs to making sure that the actual business logic that's codified in DeFi smart contracts is not kind of against regulatory rules. So I do think regulation will come to DeFi. And then, of course, one of the other issues with DeFi is identity. And this is where we simply, for privacy, cannot place identity on blockchain. But you do need to be able to somehow relate identity to operations on blockchain. This is where right now, maybe it's not the best solution, but it is a solution right now. Custodians can work with law enforcement agencies and regulators to prove to us. A lot of people on the institutional side are coming to us, working with us, because we give them a way to kind of link identity to pseudonymity on the blockchain and work with the authorities to do that. So it's not a perfect solution, in my opinion, but it does enable us to progress. Another question around CDBC as a bank business model. I think one of the things, so the question was, what do you think about CDBC as a bank business model? I think it's an interesting one. I think the interesting bit there is programmable money. So if you think about it, what got me super excited about Ethereum is that effectively I could replace a bank with a smart contract. Take atomic swaps or delivery versus payment. What required a massive organization before now can be written in 10 lines. I'm slightly exaggerating, but not a lot more than that, of smart contract code to guarantee delivery versus payment. That's super exciting. If you can increase the number of assets on chain that are programmable in that way, that's great. So CDBC is useful in that respect. What CBDC does not solve for is kind of one of the original premises of blockchain, which is, or Bitcoin at least, is that you want to reduce the risk of central issuer. So, we've seen massive quantitative easing where governments have become hooked on effectively getting themselves out of trouble through printing money. Now, they call it debt issuance and all that, but the reality is that debt's not going to be repaid for the next 25 years. So for most people, their dollar in their pocket's been devalued, and they're never going to see that money because, frankly, they're going to die before they see any return on that. For those people who don't like being devalued without any benefit and without any representation, we'll be moving to something like Bitcoin because there's no central issue that can simply print more money without consent from the consensus. So at that point, I think CDBC falls short. So it's a useful instrument for kind of having yet another useful asset on blockchain that's programmable and giving all the operational efficiencies and programmability. But kind of it's not the same as Bitcoin or Ether because it doesn't give you the benefit of kind of decentralized issuance. And I think I'm slightly overrunning. I'll take one last question. So where do you think we are in evaluation of the several DeFi protocols? Is that a bubble, or we will go down and consolidate, or is the valley concrete and we're not in a bubble? I think there are certain bubbles. We are seeing some protocols, frankly, as far as I'm concerned, inflating their value. So people are, right now, some protocols are offering staking, but they're basically, you are simply freezing assets and they're giving you more tokens for freezing assets. There's no real staking there right now. It's simply a way to incentivize people to buy the token, freeze it, so you get more. It's effectively cashback for buying. That's creating a bubble. Let's be honest about that. So I think there is that. But then there are some amazing protocols today that haven't kind of done that and are slowly but surely gaining value that I think is sustainable. You know, your MakerDAOs, your Aves, and so on. They just don't. There are many UMA project, but many other protocols that I think have genuine value, and they're not pumping them. They're doing the hard work of increasing their value over a period of time. So I think yes, there are some bubbles, but I think we're in a much better state than we were a few years ago, because I think there are, in my opinion at least, some really genuinely valuable protocols that are going across a sustainable growth trajectory. All right. So thank you so much for your questions, and I will wrap it up. And again, if you do need to reach us out, trustology.io, reach out. Thanks so much, guys. Talk to you later.